All right, pull up a chair. Today, we're cracking open the secret playbook of Columbia professor and legendary hedge fund manager Joel Greenblatt. And we aren't just going to sit here and read dry academic theory. No, we're translating his Wall Street strategies directly into hardcore Indian market realities. Look, if you're tired of losing money chasing daily market noise, and if you genuinely want to learn how the big boys actually play the game, listen up. This explainer is exactly what you need to rewire how you look at the market. Let's get right into it. 50%. Just let that sink in for a second. At his firm, Gotham Capital, Greenblatt generated a staggering 50% annualized return over 2 decades. Do the math on that kind of compounding. It literally turns small stakes into generational wealth. And the secret? He didn't do this by chasing hot stock tips on Twitter, and he definitely didn't obsess over 50 different moving averages. He executed a highly structured, emotionally detached framework where retail investors just aren't looking. He traded the uncommon.
Here's our battle plan to master these corporate actions. We'll be covering the smart money secret, profiting from buybacks, spinoffs, and demergers, navigating M&A and rights, reading market signals, and finally, the mentor's playbook.
Section 1, The Smart Money Secret, Trading the Uncommon.
So what exactly is a special situation? Basically, it's an unusual corporate event on a stock that creates forced buying or forced selling, and that structural pressure creates massive, predictable price dislocations. While the retail crowd is out there panicking over flashy news headlines or inflation data, the informed money is hunting for these finite, heavily regulated, and frankly, kind of boring events. We're talking about structural mispricing. You aren't guessing where the broader market is going. You're exploiting a mathematical inefficiency that's literally baked right into the corporate action itself.
Moving to Section 2, Profiting from Buybacks, the Arbitrage Play.
A buyback is pretty straightforward. It's when a company uses its own cash to repurchase and cancel its own shares. By shrinking the total number of shares out there, they automatically boost their earnings per share, or EPS, without actually generating a single extra rupee in profit. It's a massive signal. Management is basically shouting, hey, we have excess cash, our stock is way too cheap, and we're betting on ourselves. Sometimes they even do it just to fend off hostile takeovers. Now, for us trading here in India, the main mechanism you want to watch is the tender offer. Let's put some real numbers to this. Think about TCS back in 2018. The market price was hovering around 1,900 rupees, but the company set a guaranteed buyback price at 2,100 rupees. Fast forward to Bajaj Auto in 2022, trading around 4,200 rupees on the open market, but they offered to tender shares back at $4,600. That gap right there, between the everyday market price and the premium buyback price, that's your arbitrage window. That spread is the exact inefficiency where smart money steps in and cleans up.
So here's Greenblatt's tactic translated into a quick 4-step rulebook. 1. You buy the shares before the record date. 2. You tender them through your broker. 3. You wait for the pro rata acceptance. And 4. Historically, you aim to realize about a 5 to 10% absolute return in just 2 to 3 months. But listen to me carefully here, because I've got to warn you about the trapdoor. Your biggest risk is that pro rata acceptance ratio. Let's say you buy 100 shares. Amateurs see a 20% premium and think it's a guaranteed 20% return on their whole position. No way. If the buyback is oversubscribed, they might only accept 10 of your 100 shares at that premium. You're stuck holding the other 90. If the stock drops right after the buyback closes, your capital is tied up in a net loss. This trade requires precision, proper sizing, and a real understanding of historical acceptance rates.
Section 3. Spinoffs and Demergers, Unlocking Hidden Value.
It's absolutely crucial to understand the mechanics here. A spinoff happens when a parent company detaches a subsidiary and gives it its own separate listing. A demerger is slightly different. It's when a single company splits its business segments into 2 or more listed entities. But in both cases, these structures create massive market inefficiencies. Think about it. Imagine a giant mutual fund that's legally mandated to only hold large-cap Nifty 50 stocks. When a massive conglomerate spins off a smaller, mid-cap subsidiary, that new little company isn't in the Nifty 50. So on day 1 of listing, that massive fund is legally forced to dump those new shares at the market open, regardless of how great the business actually is. That forced, blind selling, that is your entry ticket.
Let's ground this in some real-world Indian plays. Just look at Reliance separating its financial arm to create Jio Financial Services in 2023. Or ITC announcing the demerger of its massive hotel business. When these seismic shifts happen, index funds and confused retail investors are often forced into blind selling. The retail guy sells because he doesn't recognize the new ticker symbol, and the institutional guy sells because his compliance team says he has to. This cascade creates artificially low, deeply compressed entry points. If you're deploying patient capital and you've actually done the homework on what that spun-off business is worth, you can scoop up incredible value for pennies on the ruby.
All right, Section 4, Navigating M&A and Rights, the Capital Catalyst.
A rights issue is essentially a company offering its current shareholders the exclusive right to buy new shares at a discount to the current market price. It's a fast-track way for management to raise capital. Reliance executed the absolute largest one ever in India back in 2020, during peak pandemic fear, raising over 53,000 crores. But hear me out. You absolutely cannot treat all rights issues equally. Too many retail guys just see the word discount and blindly throw cash at it. You have to know when to subscribe aggressively and when to walk away to protect your capital.
Here is the dividing line you need to memorize. You subscribe when a fundamentally healthy company is raising strategic growth capital, maybe to build a plant, acquire a competitor, or pay down expensive debt, and they're offering a genuine margin of safety, like a 15 to 20% discount. On the flip side, you avoid it entirely if you're looking at a distressed company facing heavy dilution just to keep the lights on. Think of the tragic Yes Bank situation in 2020. The golden rule here is simple. Always fund strong fundamentals, never fund blind desperation.
Section 5. Reading market signals. Noise versus action.
This is a classic trap, and I've seen so many people wipe out here. When a stock split or a bonus share is announced, the retail crowd sees a mathematically cheaper share price and rushes in, cheering like they just got a massive discount. But the smart money? They know the intrinsic value hasn't changed by a single rupee. It is purely a psychological and liquidity event. You're literally just slicing the same pizza into more pieces. MRF famously never split and trades at over 1 lakh rupees, while Bajaj Finance split multiple times purely for retail liquidity. The takeaway? Never hit buy just because of a split announcement. Stay relentlessly focused on the fundamentals.
Then we've got the offer for sale, or OFS, and its close cousin, the block deal. This is when a promoter or a massive private equity institution dumps a significant chunk of shares onto the market. When the government divests something like Coal India or a massive block deal hits pre-market, it signals heavy institutional activity. Your job as a trader is to evaluate the motive. Look for a strategic entry at a good discount if the core business is still incredibly strong and the seller is just rebalancing. But if the insiders are using an OFS to abandon ship because they know underlying distress is coming, stay away. Let the institutions fight over those scraps.
And finally, Section 6, the Mentor's Playbook, Greenblatt's Rules.
Look, to trade like a master, you can't be a jack of all trades. Pick just 2 or 3 special situation types to specialize in. You have to deploy patient capital, expecting these structural plays to take anywhere from 6 to 24 months to unfold. And here's the hard truth that separates the amateurs from the pros. You have to do the grueling work. You need to grab a strong coffee and read those massive 200-page SEB documents that lazy investors completely ignore. Calculate the pure sum of parts value yourself, exploit that forced institutional selling, and track historical company patterns. That is how you win.
Let Greenblatt's own philosophy sink in for a second. There's a finite number of these situations every year. Each is unique. They require analysis, but they're not as competitive as regular stock picking. This is absolutely brilliant. Everyone else on the street is endlessly chasing the exact same 50 popular large-cap stocks. The sheer lack of competition in these technical, boring corporate actions is exactly where your edge lies. You're playing a completely different game than the rest of the market.
So I'll leave you with this question. Are you going to keep gambling your hard-earned money on daily market noise, staring at red and green candles all day, hoping to get lucky? Or are you ready to sit down, do the heavy reading, and systematically extract wealth from the market just like the smart money does? The playbook is yours now. Thanks for joining me on this explainer. Now get to work.